The former United States President Donald Trump wanted everyone to buy American. American products, American technology, American oil, American weapons. But one item he probably did not anticipate is the growing attraction for US equities amongst Indian investors. As a matter of fact, there has been one US specific fund launch almost every month in 2021, which speaks volumes of the growing popularity of this theme. Some of these funds are actively managed while others are passive funds, but a commonality here is that most of these funds are benchmarked against the Nasdaq or the S&P 500 index. In fact, when we see the entire list of US specific mutual funds that are available for investment in India, we see a fair number of them either tracking the Nasdaq 100 or the S&P 500. And why not? After all, these two indices are composed of the United States' largest companies. They have a track record for many years and are widely followed by investors all over the world. And so in this video, we shall understand these two indices in greater details from an investing perspective as we examine their holdings, their performance in terms of risk and return, their consistency, and which index might be more suitable to have in one's portfolio. Let's begin. The S&P 500 index was launched in 1957, making it one of the oldest indices in operation within the United States. As the name suggests, this index comprises of stocks in 500 of the biggest stock exchange listed companies in the US. To put big in numbers, the total market capitalization of all companies in the US is about $48 trillion. Of these 48 trillion, the companies in the S&P 500 represent about $40 trillion or 83% of the country's total market capitalization. In other words, if the S&P 500 is doing well, then most times the US economy is doing well. Now, as is the case with most indices, the 500 companies within this index are assigned weights based on their free float market capitalization. If you're hearing this term free float for the first time, then do watch our video on the Nifty 50 where we have given a detailed explanation of it along with some relevant examples. So with the S&P 500, as is the case with most indices around the world, higher the free float market capitalization, higher is the weightage in the index. The weights of course change from time to time in accordance with the stock prices. As a matter of fact, it is the Microsoft Corporation that holds the highest weight in the S&P 500 index at 6.25% as of October 2021. However, just 1 month back, that is on the 30th of September, it was in fact Apple which held the top spot in the index. So while the market capitalization is a very important variable to the index, there are some other factors that also go into the selection of stocks for the S&P 500. For instance, profitability matters, and barring a few exceptions, companies must be profitable to get into this index. Companies that have recently gone public via an IPO must have at least 12 months of trading history. There are also some float and liquidity requirements which keeps out low public shareholding or thinly traded stocks. And finally, the selection of companies goes through an approval process which is conducted by an index committee. In fact, one of the mandates of this index committee is to keep the S&P 500 representative of the US stock market. For instance, say tech stocks make up 20% of the total value of US stocks, but hold a much greater representation in the S&P 500, say something like 50%. In such a scenario, the committee will intervene and will go about adding or removing stocks strategically to ensure that the S&P 500 doesn't differ meaningfully from the whole market, especially when it comes to sector representation. Case in point here is the technology sector, and although there are a number of technology and internet companies in the top 10 holdings of the S&P 500, the total allocation of this sector to the index is still less than 30%. In fact, the S&P 500 represents 11 key sectors with information technology, healthcare, consumer discretionary, financial and communication services forming the bulk of it. Now, when one sees relatively young companies like Amazon, Alphabet and Facebook within the top 10, one does wonder at what rate are index constituents changing in this index. One study reveals that an S&P 500 company's longevity in the index has reduced from 38 years in the early 1980s to around 20 years now, and is projected to go down to 12 years in the later half of this decade. And what's ushering this change are newer technologies and ways of doing business, including digitization, alternative energy, artificial intelligence, the sharing economy, big data, blockchain, 3D printing, hyperloop, and dozens of other things that are yet to be commercialized. The S&P 500 of the future will be a lot different than the one that's presently in front of us. The Nasdaq 100 index was launched in 1985 and represents the 100 biggest non-financial companies listed on the Nasdaq Stock Exchange. By excluding financials, the Nasdaq 100 is dominated by tech majors, which often go with a popular acronym called the FAANG Stocks. FAANG: Facebook, Apple, Amazon, Netflix, and Google. Now, with Facebook changing to Meta, I'm not really sure what's going to happen to the FAANG, but if you add other trillion-dollar companies like Microsoft and Tesla to the mix, then there are quite a few naming combinations which are floating around. There is, of course, the original FAANG, F-A-A-N-G. Then there is FAANG with a single A, which excludes Amazon, maybe because Amazon is more of a retailer, but I'm not sure about that. And then there is FAANG Plus, which includes Alibaba, Baidu, Nvidia, Tesla, and Twitter. Also, there is FAAMG, F-A-A-M-G, which finds a place for Microsoft at the expense of Netflix. And now we also have a newly minted TANG, which is a commemoration of Tesla touching a market cap of $1 trillion. Anyways, the point is technology companies are big in the Nasdaq 100 index. Together, they account for 57% of the index allocation, which might come as a surprise to some, as the general expectation is that the Nasdaq would be holding a much higher percentage in technology companies. In fact, other than technology, there are a number of consumer companies within the Nasdaq, which includes firms like Starbucks, Macy's, Domino's, PepsiCo, and others. But yes, given that the majority is with technology and more so internet companies, plus the fact that the number of companies is limited to just 100, it won't be wrong to classify the Nasdaq 100 as a tech-heavy large-cap growth index. Okay, now that we have a broader picture, let's quickly examine the top holdings. Microsoft, Apple, Amazon, Tesla, the usual suspects. But what's notable here is that the top 10 companies contribute to 55% of the index's weight, which makes the Nasdaq 100 one of the world's most concentrated indices. It's not entirely bad when you know that you are getting a concentration of the world's biggest and most innovative companies, but this is a point that we'll surely revisit in the next section when we compare the Nasdaq 100 with the S&P 500 index. Let's recap some of the differences between the Nasdaq 100 and S&P 500 based on what we have learned so far. Firstly, and this is like super obvious, the Nasdaq 100 has 100 companies, while the S&P 500 has 500 of them. As a matter of fact, technically, the Nasdaq 100 has 109 constituents and the S&P 500 has 505 components in it. These extra 9s and 5s are on account of a few companies having multiple classes of shares, but net there are 100 and 500 companies respectively. The second point of difference is on the sectoral representation. The S&P 500 has a more diverse range of sectors, 11 to be precise, while the Nasdaq 100 has a more narrower mandate with 5 significant sectors. Also, as was pointed out earlier, financials is not a part of the Nasdaq, which means this index is missing a systemically important industry within its scope. The third difference between the Nasdaq 100 and S&P 500 is the concentration element. Now, the Nasdaq 100 is concentrated in terms of companies and sectors, with the top 8 companies comprising over 50% of the index. Also, in terms of sectors, technology as a single sector presently has a 57% weightage. On the other hand, the S&P 500 is less concentrated, with technology having less than 30% in weightage, which of course reduces the concentration risk for the investor. So these are some key visible differences between the two indices, but now let's look at how they have fared from a risk and return perspective. Let's start with returns, and we see that the Nasdaq 100 has significantly outperformed S&P 500 in terms of performance over longer periods of time. So in numbers, if one had invested $10,000 in November of 2011, then that investment would have grown to $44,800 in the S&P 500 and a much higher $71,800 in the Nasdaq 100 index. On an annual basis too, the Nasdaq 100 has outperformed the S&P 500 in most years within the last decade. This outperformance has sometimes been by a big margin, as we can see in 2015, 2017, 2019, and of course in 2020. What's even more interesting is that while the Nasdaq 100 has outperformed, it has also managed to keep its annual volatility around the 21% mark, which is quite similar to the S&P 500's volatility over the last 10 years. In all honesty, we found this a little surprising when one factors in that the Nasdaq 100 has a lot fewer stocks and is a heavily concentrated portfolio in terms of companies and sectors as compared to the S&P 500. So at least from a risk-return equation, the Nasdaq 100 has certainly outdone the S&P 500 in the past decade. There is no denying that the FAANG stocks have been the engine that has driven the Nasdaq for much of the last decade. Facebook, Apple, Amazon, Netflix, and Google, in addition to serving millions and billions of consumers all around the world, have also set the stock markets on fire. These 5 companies account for almost 35% of the Nasdaq 100 in terms of allocation and contribute to over 40% of the returns of that index, which is another way of saying that the Nasdaq 100 is more sensitive to the FAANG share prices than that of other smaller companies. Now, given this sensitivity, a question that often props up with investors is, are the FAANG stocks too expensive? Alright, so we all understand the premise here. The 5 FAANG stocks have done exceedingly well over the last 5 years with annualized returns of anywhere from 23% to 40% per year. Further, these stocks are presently available at a relatively high price to earnings multiple, which implies that investors see a lot more growth in these companies, and many of the FAANG stocks have done just that in the recent past. Take Google Maps as an example. The service was launched in 2005 and after many improvements is today the most prominent mapping service on the planet. In numbers, over 1 billion users access the service every month, and per estimate, it earns Google an annual revenue of $5 billion, which is expected to cross 10 billion over the next 3 years. And it's not just Google which has been doing this. Amazon, for instance, has been funneling back cash flows from its AWS, the Amazon Web Service business, into other small and promising initiatives. Likewise, we have Facebook, which has extended its runway with Instagram and WhatsApp, Apple, which continues to build MacBooks to iPods to iPhones to the Apple Watch, possibly cars, virtual reality devices, medical devices, maybe a smart home system, etc. And in doing all this, the FAANG stocks are basically widening their moat, which makes it difficult, almost impossible for a competitor to come in and take away their dominant position. So while we have not done any valuation in this video, the attractiveness in FAANG stocks comes from a combination of having an established business that is generating billions in cash flows, strong competitive advantages, and a long growth runway. From a performance point of view, the Nasdaq 100 is the outright winner. Year after year, the Nasdaq 100 has edged past the S&P 500, and what came as a surprise to us is that they have done this without veering too much in terms of volatility. However, with the Nasdaq 100, one can't hide behind the fact that the index is a thematic one with a massive tilt towards technology stocks, and like every thematic fund, there are likely to be up and down cycles. In our view, this up-down cycle is not likely to be in terms of the demand for technology, but more so in terms of valuations, which can get stretched very quickly and more difficult to justify as companies become even bigger. And this sort of makes the decision a bit easier now. If one wants to invest in the growth of the entire US economy, that is in their banking, consumer goods, energy, technology, etc., then the S&P 500 fits in right away. It has diversity, has a long track record, it has large cap companies, and these companies are systemically important not just for the US but for the entire world. However, if one is keen on participating in US technology and internet firms, then it's better to opt for the Nasdaq 100 and own a piece of Apple, Microsoft, Amazon, Tesla, Facebook, Alphabet, and other emerging and established tech companies. In either case, do ensure that the fund you choose fits in properly with your overall portfolio allocation. And if you want to look at international funds beyond the S&P 500 and the Nasdaq 100, then don't miss out on a related video on the ETMONEY YouTube channel. And with this, we come to the end of this video. If you learned something new today, then do tap on to that like button and get your friends to subscribe to our YouTube channel. Thank you once again for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.